Okay, you're live.
All right. Welcome to our second fall meeting for the Joint Committee on Pensions. I'm Senator Michael Jackson, and I co-chair along with Delegate Catherine Forbes. Delegate Forbes.
Good afternoon, everyone.
And today we have our 2024 actuarial valuation and 2025 contribution rates meeting. So we will proceed. We have with us Martin Novin, Brian Murphy, Amy Williams, and Jeff Tebow. And if you all will proceed in that order, we can commence. Thank you.
Okay, we'll be glad to start. Jeff, are you going to share the screen so that they can see the slides?
Yes, sir.
Okay, does everyone see the slide that's on the screen now? Yeah,
Yes.
Okay. So just to introduce ourselves, I'm Brian Murphy, and with me is Jeff Tebow and Amy Williams. We work for the actuarial firm that serves the state retirement and pension system. We were thinking of talking for about 20 minutes, leaving 5 or 10 minutes at the end for questions, if that suits everyone.
That's okay.
Unless we hear, a terrible objection, no, then we'll go on. We're here to talk about the actuarial valuation. This is kind of a study that we do each year. We look at the people covered by the state retirement and pension system. We look at the assets that it has, and we make projections into the future about how much money will be needed going forward to cover the future pensions of all of these people. And that's kind of what an actuarial valuation is. So it's a point in time snapshot. It's done every year. And each year is sort of a self-correcting process. All the things that didn't happen quite the way we thought last year, we adjust for this year, and so on. So if you go to the next slide, Jeff. So this is our quick table of contents. We'll be telling you what the valuation is, who the people are, what the assets are. And notice we listed the participant data first, because we always want to keep the focus on the people. That's what this is about. The system covers over 400,000 people. And if you think that each of them may have a spouse or dependent, we're a big part of the financial responsibility for 800,000 people in Maryland. And that's a really important responsibility. Jeff will talk about the participant and asset data, and then Amy will take you through the results of the valuation, and then I'll kind of wrap it up. So next slide, please.
Just watching.
So here's what we're here for. Measure the financial position of the retirement system. What percent funded are we? Well, that's a question that's often asked, and you'll find the answer to that as we go on. Provide the board and the state with the state and PGU contribution rates for certification. A lot of money is put into the system every year to cover benefits. And part of the valuation process is we try to tell you how much that is, and we make the best projection that we can. Then the valuation also gives financial reporting information that's important for GASB calculations, for the accountants, and then finally we look at experience over the last year. And the next slide. So the valuation is about funding the retirement system. Now that's what we're trying to do, is trying to tell you how does it stand from a funding perspective, how much money is needed going forward. And the objectives of the funding program are the 4 things listed in the colored part of this slide. First, benefit security. That's listed first because that's the absolute most important. We want to be sure that going forward, we can always pay the benefits that we've promised to all of the people to whom we've promised those benefits. That requires commitment on the part of the plan sponsor, the state, the municipalities, to make the contributions as required. It requires strong governance, being sure things are done right, good administration, and naturally lots of money. The next thing that we'd like is to have a stable pattern of contribution rates. It wouldn't do if every year we had wildly different contribution rates. The state couldn't manage its budget that way. If every year it's up $1 billion or down $1 billion or something, that just wouldn't work. So we try to arrange things so that things are stable over long periods of time. The next thing is we want what's called intergenerational equity. We would like to ensure that each generation of taxpayers pays for the retirement benefits of the public employees who serve them. That's a difficult part of the calculation, and somehow, the sad part is we don't actually know what the plan costs. We only know what we think it costs today. It might be a different number tomorrow. we do the best we can. And then finally, we'd like the stable or increasing ratio of assets to liabilities. We would like in the long term for the system to get better and better funded and eventually to reach 100% funding. And once it reaches that, we'd like to see it stay there. Now, that's what we think is important, because when the system is fully funded, that creates a pool of assets from which benefits can be paid, and it provides the greatest benefit security and is the best for all concerned. So with that, I'll turn the baton over to Jeff, who's going to talk about the assumptions that we use in the evaluation, and some of the other information. Jeff? And we don't hear you, Jeff.
My bad. I was on mute there. So as Brian said, the next couple slides just go through some additional information concerning the actual inputs that we make into the actual evaluation. And so one of those inputs are the assumptions. And so we have two types of assumptions: economic assumptions and then the demographic assumptions. So our economic assumptions generally deal with the money, and the demographic assumptions deal with the people. And it just so happens that this year we conducted an experience study where we look at the different experience and kind of our understanding of what might happen in the future to kind of adjust the assumptions so that our model is essentially predicting liabilities as close to what we think will happen in reality. Of course, that never works out exactly, but we, as Brian said, we do our best. And so really,
Jeff, if you could, you mentioned that this year you guys incorporated the experience study, and it shows here first used in 2024 valuation. Is that something you all believe you'll be using going forward, or is that going to be on a set periodic basis? If so.
yes. So the assumptions that we use are generally reviewed every 4 to 5 years or so, which is kind of an industry standard. 5 years probably being the most common. And so we expect that we'll continue to use these assumptions for the next 5 years, barring any kind of very, catastrophic change in maybe economy or something like that. But generally, that's our expectation for the most part. Now, we do review certain assumptions kind of on an annual basis, more looking at the economic assumptions, especially the investment return assumption, which is generally scrutinized a little bit more by not only actuaries, but people looking in at the system as well. And so as long as the kind of the capital markets indicate that 6.8% investment return assumption is still reasonable, we would expect to continue to use that, unless, of course, there's changes in either the asset allocation, investment, policy of the fund, or, like I said, there's a change in kind of the capital markets that would require us to do something like that.
Okay, thank you.
So really, the experience study was pretty anticlimactic as far as its impact on the system. So this is something that we've seen in other working on other systems, that many of the demographic assumptions were just kind of small tweaks, whereas and also in the recent past, many of the economic assumptions have been, especially the investment return assumptions, have been lowered to kind of reflect the capital market expectations. And so we're a little bit in this kind of a sweet spot where we're not changing assumptions too drastically, which hasn't been the case in the last 10 or 15 years, where there's been a more dramatic changes in assumptions. The one thing that kind of sticks out was the board adopted an increase to the payroll growth assumption, which is relying on the price inflation assumption, which both of those were increased by 0.25%. And so that obviously impacts, what the model, our valuation model, is going to predict salaries to be, and of course, ultimately what the benefits will be. It also impacts the cost of living increases that retirees receive, since many of those are linked to inflation. And so when we assume that inflation is going to be higher in the future, that also means that the cost of living increases will be higher as well. So the next slide just gives us a quick overview of the other inputs into the valuation. So of course the benefits, what the actual benefits are, as Brian said, will determine the actual cost of the plan at the end of the day. The actual cash flow going out to the retirees is the real cost of the plan at the end of the day. And so of course we want to do our best to model that past experience. So whether we get the correct amount of funds each year from the state and the local governmental units, and as well as things like our investment return, has that matched up with assumptions, and whether it has or not, to the extent that it has or not, we may have more or less money in the system that we expected, and so we need to either make up that shortfall, as we are currently in that kind of situation where we have what we call unfunded liability, essentially is past liability that hasn't been funded for whatever reason. We might not have received the investment income that we wanted, or we increased benefits or changed assumptions. All those things impact the liability. And then we also have a rundown of recent legislative changes that I'm sure all of you are quite aware of. Most of these have been pretty minor impact to the system. The one that we've kind of been more instrumental in, I suppose you could say, is the implementation of the layered amortization. So changing from a kind of a single closed period to using a layered approach, just to mitigate some of the volatility that happens when you're paying off unfunded liabilities over a short period. So you'll see the effect of that in the valuation, in this valuation as well. So for the first time. And then finally, the last couple pieces are the cost method, which is essentially how the valuation divides the costs for the liabilities between the past, the present, and the future. And so we use what's called the entry age actuarial cost method, which is a very common cost method used in the public sector, and essentially divides the cost up over an employee's lifetime, as generally as a percent of their pay. So when you see, normal cost, that's what that is essentially referring to, the cost that of the ongoing plan that the cost method assigns to the current year. And then we also employ a smoothing method, which is very common as well in funding these types of retirement systems. Just smooths out some of the volatility in the market, which I'll kind of show you a little bit later. And then really the other big piece is how we pay for that unfunded liability. And so, as I mentioned, the 2024 valuation first, we started the layered amortization. So that means that the bulk of the unfunded is kind of on the current schedule, so to speak, of being paid off by fiscal 39, so 14 more years. And then any new unfunded liabilities that are occurring after July 1, 2023 get amortized based on various periods depending on the source of the unfunded liability. So normal experience and gains losses are amortized over 15 years, and then anything like if we change assumptions, which we did in 2024, that gets amortized over 25 years. Benefit changes are generally a lower period, 10 to 15 years. So that essentially just helps to smooth out the volatility in the contribution rates, which helps meet that objective that Brian mentioned about having a relatively stable contribution rate each year. So that's for the state systems. The municipal systems, they are still using a single period for their amortization. So the ECS municipal is at 18 years, and then the other two LEOPs and CORES are at 15 and 22 respectively. And again, so similar to the state systems, we believe that those will have to be kind of re-examined pretty soon here to make sure that it's still meeting the needs of the system, and making sure it's not becoming too volatile of a contribution on the state and the local employers. All right, so now we skip forward to the actual kind of results, so to speak, of the evaluation. So as Brian said, we like to take a moment and look at the participant data. And so, as you said, there's about 427,000 members in the 2024 valuation that we are valuing for the census data. And so, as he said, there are other people that we aren't necessarily counting, such as spouses and family members that are also relying on these benefits. But the one thing to note kind of here is that the active member count, which you see in the top row there, has been increasing for the past couple of years. And so that's generally a good thing for the system to help support the number of retirees that continue to increase as well every year. But generally, when having so to speak, a younger plan where you're having more active members entering the system every year, generally helps the sustainability of the plan. Just having more members to support those retirees. And most systems that have been around as long as Maryland are, fairly mature now. They have quite a few retirees. So you can see that the retirees are 176,000. So they're catching up slowly to the active members. So generally, when we expect that ratio of active to retired members will reach, they'll kind of reach the same level at some point. And many mature retired systems are kind of actually beyond that tipping point where there's more retirees than active members for whatever reason. So you'll also notice that the valuation payroll, because of the increase in headcount, has been increasing as well over the last couple of years. So almost 9% increase in payroll, which does have an effect on the valuation, especially the liabilities that are calculated for the active members. So not all of that is due to the increase in headcount. It's also due to greater than kind of expected salary increases that have been granted in the last few years as well. So we've seen that in the last couple of valuations. And again, with the retirees, kind of at the bottom, their statistics down there, you can see that the total retiree payroll, so to speak, has now exceeded $5 billion. And so again, that's a almost 5% increase over the last year, due to just having more retirees plus those additional cost of living increases, which have been slightly higher due to the inflation that we've seen in the last couple of years. All right, now getting into the assets just real briefly. So in 2024, the market value of assets, you can see kind of in the shaded line here, was just shy of $68 billion. And so our estimated return for 24 was 6.88%, which is just over the actuarial return assumptions. So there was a slight gain as far as the market value is concerned. However, because we smooth that out by recognizing gains and losses over a 5-year period, that means that we're combining losses and gains from the last few years. And so when that happens, you generally have, if you have losses kind of to be recognized, which was the case in 2024, that means that your return assumption is going to be a little bit lower. So as far as the funding portion of the assets is concerned, we came out to about a 5.6 rate of return, which is actually very close to last year. So there was a couple losses, so to speak, because we measure those returns against the actuarial assumption. And so when it's below the 6.8%, that means that we had a loss overall, but still fairly close to the assumption. So it wasn't as impactful as you'd see if you were doing a pure market value basis. So, however, if you look at this slide here, you can see kind of how the actuarial value, which is the green bars, and the blue is the market value, kind of track each other. And so depending on the year, they can go up and down, so to speak. So in 2021, there was a very good year as far as the investments were concerned, most systems, were in the 20 to 25% return rate. And so you had a large increase in the market value. And so the actual value is kind of slow to catch up because it's only recognizing some of that gain each year. So if you were to kind of draw a line from each of these, from the green bars and then the blue bars, you would see that the green bars are much more volatile and the blue bars are a little bit more stable, which is the design of why we use an actual value of assets to make sure that we try to stabilize the contribution rate slightly as best that we can. All right, so I think I'm going to pass it to Amy now to go through the actual, more of the actual results of the evaluation as well.
Okay,
Thank
if you would, Amy, for a second, any questions from any of the members before we pass it? No? All right. Senator Solomons, you good?
Good.
All right, thank you, sir, for being here. Miss Amy?
Good afternoon, everybody. On this slide right here, before we talk about the details of the actuarial valuation, this slide discusses how plan experience and other factors affected the contribution rates. So there were some factors that increased the contribution rates, and then there were some factors that helped offset some of the increases in the contribution rates. So on the left-hand side of the slide, these are the components that contributed to increasing the contribution rates. So the first item is that investment return, when we look at the smoothed or the actuarial value of assets, was lower than the actuarial assumption. Based on the asset smoothing, the return was 5.56%, as Jeff mentioned, versus the assumption of 6.8%. So that is a loss, which increases the contribution rate. The next item is that individual member pay increases were higher than assumed based on our actuarial assumptions. So again, that created a loss to increase the contribution rates. The third item is related to cost of living increases or COLAs on retiree benefits. For a retiree that receives an increase based on the change in CPI or inflation with no cap, those retirees received an increase of about 4.1% compared to the assumption of 2.25%. And similarly for the retirees that receive an increase with a cap. So since the actual retiree benefits increased by a higher amount than we were assuming, again, that served to increase the contribution rates. And finally, we incorporated assumption changes based on the recent experience study, and those assumption changes had the impact of increasing contribution rates. However, there were some factors that helped to partially offset those increases in the contribution rates, and those are listed on the right-hand side of the slide. So the first item is that the total payroll base is higher than we were expecting, based on membership increases and then based on individual member salary increases. So what this means is that the unfunded liability contribution is spread over a larger payroll, thus resulting in a lower contribution rate. So to give you an example, a very simplified example, if the unfunded liability payment that the plan needed to collect was $50, if we expected the payroll to be $100, that would be a contribution rate of 50% of pay. However, if the payroll was higher than we expected, higher than the $100, if it was $200, that would mean that the contribution rate would be 25% to collect $50. So we're still looking to collect the $50. However, based on how big the payroll is, the contribution rate is higher or lower. The second item that helped partially offset the increase in the contribution rates was that more members are in the reform systems. The reform systems have a lower cost. So over time, as more members are in those systems, that helps to slightly reduce the contribution rate each year. And then finally, the implementation of the layered amortization, which factors into calculating the contribution requirement, did help to partially offset the increases in the contribution rates from those other factors. Next slide, please. On this slide right here, we have a 10-year history of the funded ratio and other key valuation metrics on a combined basis for the state and the municipal systems. So we have 3 bars and 1 line. So the bars are represent the actuarial accrued liability. That's the bar all the way to the left for each year. That is blue, the tall one. That's the benefit obligations. The middle bar is the actuarial value of assets. That's green. And then the bar to the right is the market value of assets. Then the line that we have at the top is the funded ratio. So that's the actuarial value of assets divided by the actuarial accrued liability. So you can see that 10 years ago, back in 2015, the funded ratio was 69.7%. Then over time, the funded ratio increased each year to a high of 77.2% for this 10-year period in 2022. And then over the last couple of years has declined a little bit to the 73.4% as of June 30, 2024. Next slide, please. On this slide right here, we have a summary of the valuation results for the 5 state systems. So we have a column for each of the state systems, and then we have the results on a combined basis in the total column all the way to the right. So focusing on that total column, the actuarial accrued liability or the benefit obligation as of June 30, 2024 was about $88 billion. The actuarial value of assets, which is the smooth value of assets, in total was about $64.2 billion. The difference between the two, liabilities minus the assets, is the unfunded actuarial accrued liability, which is about $23.8 billion. This is an increase of about $2.8 billion compared to the unfunded liability in 2023. Next, we have our funded ratio. That's the assets divided by the liabilities. For the state systems, on a total basis, that funded ratio is 72.9%. That is a decrease of about 1.8% compared to last year. And then finally, the bottom rows are related to the employer contribution rate. These rates apply to fiscal year 2026. The total rate is 20.23%. That's an average contribution rate across the 5 systems. The contribution rates that will apply are the specific rates for each of the 5 systems. So on average, the contribution rate increased by about 1.08% of pay compared to the contribution rate for fiscal year 2025. And then each of the individual systems, were impacted somewhat differently based on the plan experience, based on actuarial assumptions. So in turn, their contribution rates and funded ratios each changed by different amounts. Next slide, please. On this slide right here, we have a summary of the results for the municipal systems. So the slide is set up in the same way as for the state systems. At the top, we have the actuarial accrued liability. In total for the municipal systems, about $7.8 billion. Assets of $6.1 billion. The difference is the unfunded liability of about $1.6 billion. This is an increase of about $300 million from last year. The funded ratio about 79% in total, a decrease of about 2.7% from last year. And then finally, the basic or pooled contribution rate applicable to fiscal year 2026. The average contribution rate is about 11.74% of pay, which is a 1.42% of pay increase from last year. And the actual rates that'll apply are the specific rates calculated for each of the 3 systems. Next slide, please. And then finally, on this slide right here, we have some historical information on non-investment cash flows. The stacked bar represents the contributions or the money going into the system. The blue bar is the employer contributions, state contributions. The green portion is the contributions coming from the members. The turquoise line that is above that, that's the disbursements or the benefit payments and expenses. So that's the money that's going out of the system. You can see that there is a gap between the top of the bar and the line. That means that there's a shortfall. There's more money going out than coming in terms of non-investment cash flows. The non-investment cash flows as a percent of the market value of assets are represented by that bottom line right here. So that percent has been increasing slightly over the past 10 years. It's about negative 2.1% as of the valuation date. So, this is something normal and typical that we see for more mature systems, that contributions are less than the benefit payments being paid. It is something that we do monitor, but this level of negative cash flow is not a cause for concern. And then happy to answer any questions on the section that I covered. Otherwise, I will pass it to Brian to wrap things up.
All right, before we move forward, any questions for anyone? And I'm trying to see, so you may have to just speak up if you have any questions or concerns. I don't hear anyone. So Amy, if you would, for me, I saw on these, one of your slides, it looked as if the state police they were the lowest on this particular sheet, the 1.5. That's below. Was that a decrease from the previous year?
Yes, each of the systems had a decrease in the funded ratio from last year, except for LEOPS, which had a very slight increase in the funded ratio. So the combination of the plan experience, like the retiree COLAs, the higher than assumed salary increases, and then the impact from the actuarial assumptions, and then the investment experience, all of those contributed to the decreases in the funded ratios for state police and the other 3 systems that had decreases.
Okay, if there, and you could do this later for us if you would, if you could provide us the contributing factors to some of those for us.
Yes, we do have a reconciliation of plan, the plan experience factors and the other things for the system. So that is something that we can provide.
All right, thank you. All right, we can proceed.
Okay, well, thank you, Amy. Thank you, Jeff. I'll just do a quick wrap up, and then if there are any other questions, we'll be glad to try to answer them. And I did make a note that that we should forward the sort of the pluses and minuses of the changes in the funding ratio after this meeting. We've been talking about percents for quite a while, and I think Amy said something like the average contribution is 20.23%. And we do that because the benefits are related to payroll. So we express contributions as percents of payroll. This slide shows you what the contributions are estimated to be approximately in terms of dollar amounts. So for fiscal 26, we show different numbers for each main system: TCS, ECS, state police, judges, LEOPS. The total estimated contribution for fiscal 26 is $2,928,000,000. A portion of that is paid by TCS local employers, so that the state's total contribution for fiscal 26 is estimated to be $2,489,000,000, and that varies by group, as I said. And that compares with $2,147,000,000 from the prior year, which you see in the lower right-hand corner of the slide. So there's an increase of 342 million, if I did the math right, from one year to the next in the contribution. And that was caused by some of the factors that I believe Amy and Jeff actually both mentioned. Less investment return was recognized than we assumed. Pay increases were higher than we assumed. COLAs were higher than we assumed because of the inflation that has been bothering a lot of people. And then assumptions were changed, and that also was part of the upward forces there. The changes in assumptions related to a little bit higher inflation, a little bit higher pay increases going forward. Those things taken together explain most of the difference between the two numbers in the bottom row of this chart, the 300 and some million that I talked about. Any questions on that slide? If not, quickly go to the next one. The next one we didn't put dollar amounts on, and that's because the municipal corporations, they pay this basic rate as a percentage of their payroll, but they have to pay other charges based upon various things that have happened over time. The total municipal payroll is, I think, about $1.7 billion, and then it's divided up amongst each of these groups, as we've seen. But as with the state contribution, you can see that each of these groups does see a contribution rate increase from one year to the next. And that's caused by effects such as the ones I described in the previous slide. Next slide. So these are our concluding comments. I've said it 3 or 4 times now. Contribution rates have increased since last year. The reasons are listed in the bullet points there. Experience, assumption changes. The new amortization policy that I think Jeff talked about actually have to dampen those increases. We expect continued upward pressure on contribution rates through fiscal 29 due to what we call deferred asset losses. And you'll recall in one of the earlier slides, I think Amy talked about it, it said that the actuarial value of assets is 70 billion, I think, and the market value is only 67 billion. And that gap between actuarial value and market value has to get recognized over the next several years. And as that happens, we see a propensity toward what we call actuarial loss, which will raise contribution rates. And I think that's the end of our story. And we'll be glad to take any other questions that you might have. We will follow up with the one item that was requested.
Thank you very much for the presentation. Any questions or comments from any members? And again, I'm having a problem with my being able to see. So if you have a question or comment, feel free to speak up.
Hi, Mr. Chairman, I have a quick question.
All right,
This is
Senator
Sally
Hellman.
Edelman, thanks. Looks like our return is on the low end of kind of what the expectations are. And I just wonder if you can talk about that, and then can you comment on kind of, I assume that's net of fees. If you can kind of talk about how that all works, that would be helpful.
Go back maybe to that slide that showed the returns, Jeff. Okay, this slide shows the development of the assets from one year to the next, and then shows the rate of return. The number that you would compare with somebody else would be the 6.88%. That is the rate of return that was achieved in the market value of assets. We're actuaries, so we don't get into why the system earned that rate of return. That would be more something for your investment people to talk about. But what we would say is that these returns are generated by the portfolio as it's created. It's affected by your cash flows. And finally, I would say that, when I look at, P&I, pensions and investments, sort of the industry newspaper, they will often have pages in there that rank the returns of systems from highest to lowest. And they'll say, well, this system got that return, and the next one was that one, and so forth and so on. I'm not a big fan of comparing returns from one system to the next because every system is different. Each system has its own allocation based upon its own risk analysis. And so that I tend to look at the returns of a system and how it compares with what was expected. So that's about all I have to say on that. Jeff or Amy, if you'd like to add or expand, that'd be great.
No, I think you said it well, Brian.
I appreciate.
Sorry.
I appreciate that, and I do understand. Manager Andrew Palmer, if you'd like to weigh in a bit to help out with the question from Senator Hellman.
Thank you, Senator. Yes, I'm happy to do that.
Thank
And
you.
we can go into more in depth in December when we're back for
Yes, sir.
the overview. But as Brian mentioned, we have a different asset allocation than other asset managers and other pension plans. And for us, the primary contributors to what's holding us back a little bit in this recent period is that we have a larger allocation to private assets. And one question you had was, are these all net of fees? Yes, they all are net of fees. These are the returns, the dollars that are available for the beneficiaries. And so what's happened is the public markets have rebounded more rapidly than the private markets. And part of that is just the way prices are recognized. It happens with a delay in the private markets. So they cushioned us on the way down when everybody else was down in 2021, when they were down, or 2020, I'm getting the years mixed up. 2022, people were down a significant amount, 12, 13%. We were down 3%. They bounced back, and we bounced back a little bit. So we're just less volatile. And so we expect that'll that difference will narrow over time. And that's what we see. And to Jeff's points, to Brian's point, we look at our returns relative to our target over long periods of time. And we've been a little bit below that, a little bit for the last couple of years because of the downdraft in the not last year, but the 2 previous years, kind of being a little bit below our target, but within our range of expectations. But we've been moving back up toward that long-term expectation, and we think that our path has been smoother. So that's kind of where we are. So we expect that'll be relative to other plans, that differential will come down in the next year or two.
I appreciate that. Senator Hellman, are you good? I know that we will have our final meeting in December as well. So
I'm good for now. Thanks.
thank you very much. Senator Benson.
Yes, thank you very much. For the educators in the great state of Maryland, we have two kinds of systems. One is the pension system, and one is the old retirement system. At some point in time, I would like for you all to sit down with me or with this committee to talk about a comparative study. How does the persons in the pension system fare relative as it pertains to the people in the old retirement system? That's number one. But number 2 is how does our retirement compare to the retirement of the law enforcement community? Is that possible?
Senator, are you asking for a comparison of the difference in benefits between the state law enforcement plan and the state police plan, or generally nationally looking at law enforcement? Because I don't know that we would be able to compare you to other public law enforcement plans, but I can certainly put together a chart for you that shows the different benefits and give you dollar amount examples of what the different benefits would be in the teacher's retirement system, the teacher's pension system, all of the systems. I don't want to limit you just to law enforcement. We can do it for correctional officers, the employee system, all of them that we have.
That would be wonderful. Thank you.
I can get that together for you.
Thank you.
Thank you, Ms. Gothrop. If you could share that with the committee as well. Appreciate it. I don't see any more questions. Madam Chair?
No questions, thank you.
Okay. All right. Well, I guess we can wrap up. And thank you all for your presentation today. Always a lot to digest and to learn as we look forward to our December meeting. I want to thank everyone for participating today and wish everyone a great Thanksgiving and the beginning of the holiday season with your families. And Madam Chair, if you want to close us out.
Thank you all for being here tonight. Thank you for the presentation. And I'm wishing you all a really happy Thanksgiving.
And I guess I would say right back at you.
Bye-bye, everyone.
Thank you.
Take care.